I would like to look into what makes equity funds unique. Why are they unique? So I'm considering the characteristics and then the features of equity funds. Equity funds, also known as stock funds, invest primarily in stock or equities. And so here are the key characteristics of equity funds. Number one is that focus on capital appreciation. Focus on capital appreciation. The primary goal or the objective of equity fund is to achieve long-term growth by investing in a diversified portfolio of stocks, aiming to increase their value over time. And so just like the name suggests, equity, meaning shares or stocks. So they essentially invest primarily on stocks of different companies in the stock market. Number two is higher risk. Generally speaking, the stock market could be risky because of the inherent fluctuations in the market. Equity funds tend to be riskier than bond or money market funds because stocks are more volatile, and their value can fluctuate significantly due to market conditions, company performance, economic factors, and even human behavior and market sentiments can cause the market to fluctuate. Someone asked JP Morgan what the market will do, and he responded, it will fluctuate. The market is going to fluctuate. So fluctuations, the volatility is a key component of a typical stock market. Number three is diversification. Most equity funds invest in a broad range of stocks, across different sectors, across different industries, and across different geographies. So this diversification helps to reduce the risk associated with investing in individual stocks. By the time they spread their risk across different sectors of the market, different industries, and even different geographies, either internationally or internally. So this diversification helps to kind of reduce risk. Number four is dividends. And actually, some equity funds, they invest in dividend-paying stocks, providing that steady source of income, in addition to the capital gain they produce. So, however, the amount of dividend depends on the companies in the fund portfolios. If the constituent company in the portfolio are the type that pays, that pay dividends, discover that the fund will have a higher level of dividend income. But if they don't really pay much or they don't even pay at all, that will affect the dividend yield or the dividend expectation from these funds. Number five is types of equity funds. Types of equity funds. You have growth fund, you have value fund, you have blend funds, as well as some sector funds. I take them one by one. Growth funds. Growth funds here, they focus on stocks of companies with a higher growth potentials, often reinvesting their profits rather than paying out dividends. These are growth-oriented companies. They will not pay out dividends, but they plow out the dividend into the operation to kind of to enhance growth, to fuel growth in the company. Number two here is value funds. So they invest in undervalued stocks with the potential for price appreciation as the markets come to recognize their true worth. The other one is blend funds. Blend fund combines elements of both growth and value investing strategies. They're kind of hybrids, growth and value combined together. And you have sector funds. Sector funds invest in specific sectors such as technology, healthcare, utilities, consumer, you know, discretionary. So these are actually the types of equity funds you have. And number six is market exposure. Equity funds provide exposure to the stock market, which can be either domestic, that's your home country stocks, or international, that's stocks outside your home country, such as emerging markets or developed global markets. Please subscribe to this channel and like this video. If you really like what I'm doing, please go to my channel. I have you know plenty videos that deals with stock market investments. They are designed to make you a better informed decision. And remember, the more you learn, the more you earn. Number seven rather, is management style. There is the active management style and there is the passive management style. Let's look at the active management style, the active funds. So active funds, the fund managers actively, make decisions on which stocks to buy or sell, aiming to outperform the market. Unfortunately, a vast majority of active managers don't outperform the markets, and those that don't do it regularly. Number five is passive funds. These funds track an index. It could be the S&P 500 or any other index, with the goal of matching the performance of the index they've benchmarked themselves against. Rather than trying to beat the market, they want to mirror the performance of the index that is serving as their benchmark. Number eight is liquidity. So equity funds are highly liquid, as they can be bought or sold on any trading day, in the stock markets at the current net asset value of the fund. Number nine is expense ratio. Equity funds typically have a higher expense ratio than bond or money market fund. The expense ratio is somewhat high, especially the actively managed ones, because they involve more research, more management, and the job involved in actually producing the returns they produce is not easy. It requires expertise, skills, commitments, dedication. To number 10 is volatility. Volatility here is we all know that the market is volatile, quite all right. And so due to the nature of the stock market, equity funds can experience significant short-term volatility. However, over the long time, they have historically provided a higher return than higher returns than other types of funds like the bond funds. The risk is there, the volatility is there, the fluctuation is there, but the returns are known to be higher based on historical data. So these characteristics makes equity funds suitable for investors seeking higher returns and are willing to accept the risk associated with the fluctuation of the stock markets. Personally, I prefer equity funds than other funds. Do I invest in equities, in stocks directly? But in a case where I need to have a managed fund, I think I will go for an equity fund compared to bond funds, and other kinds of funds.